Hi, I'm Ross from Lifetime Property Accounting, and we're going to go through the simplest, best tip to reduce your tax on your rental properties. Hopefully you've heard about this one before. We've been doing them for about 20 years, so it's nothing new. It's not a secret. It's a simple, easiest, best trick. Um, Picture, it probably gives it away a little bit. Value at chattel's depreciation. So yeah, if you've got a rental property, you're looking at reducing your tax because you're making a profit. Simplest, best tip to reduce your tax on your rental properties is get a chattel's valuation done by Valueit. They're pretty much the only one who knows what they're talking about, so I'd only recommend them. They'll spend 2 or 3 hours at your property, costs around $500, and you'll get a report of all the different chattels. Um, every now and again we hear some funny things where we hear, oh, we don't do it because of depreciation recovered. That's not a valid reason to not get a chattel's valuation done and not doing chattel's depreciation. Depreciation recovery related back to building depreciation, it stopped way back in April 2011, so a long time ago now. And what used to happen with buildings, you depreciate them down and down in value, they'd actually go up in value, so you'd have to recover your depreciation you claimed as income. With chattels, that does not happen. Your carpet, if you buy it, it goes down and down and down in value. You do not sell it for more. It goes down and down in value. So if you do sell it, yeah, there's generally no depreciation recovery, or if there was, it would be very, very small because all your chattels do actually wear out and they do reduce it in value. I hear some people go, oh, I just do it myself. And I look on the ground where I am, I'm looking at the carpet in my office. There's no way I'd have a clue what this carpet is worth. It's pretty much impossible to work out for tax purposes, and it needs to be for tax purposes what each of the chattels is worth. So yeah, to me, much better to spend the $550. You're going to get a much bigger list. You're going to get much more depreciation. It's going to save you a whole lot more tax. Even recently, I heard even a worse one. Oh, we don't claim it and we claim the write off later. At the end, well, you still need to establish what the value of those assets are for a write-off to occur. So you'd have to get the valuation from value at the start anyway to work out those values. And secondly, you're either deemed to have depreciated, which means that yeah, you're deemed to have depreciated that asset down and down and down in value, so your write-off would be tiny at the end, say 5 or 10 years later. Or, yeah, you've advised IRD that you're not depreciating, therefore you're not allowed a write-off. So that doesn't work as well, and that came from an accountant. Yeah, that's not great advice. You get the odd one who goes, I just don't believe in it. Again, it's not a valid reason. You are going to get from, yeah, a chattel's depreciation. If you've got a profitable rental and, yeah, you're going to make some profit long term and pay some tax, if it's a reasonable property that's got reasonable carpets, curtains, dishwasher, stove, heat pumps, that you're easily going to get your $500 back. In some cases, you might get 5 times, 10 times, or even more back from it. Something like a brand new property, if you're going to make a profit from it, it's going to make sense to get it done. The only time when you would think not to get a chattel's depreciation done, if you've got a reasonable value property, would be if you're making a huge loss, it's your only rental, you're going to sell it in 2 or 3 years, you're never going to buy another rental, in which case it's not about reducing your tax because there is no tax because you're making a loss. So in that situation, it wouldn't be worth it because your loss is already there. But generally, most of our clients, most property investors, we might start at a loss, but we want to build into a profit. Yeah, we actually want to be paying tax at some point, maybe the smallest amount possible. But we actually want to make a profit. We want to get ahead. We want cash flow from our properties. We want to pay down the debt long term and get some passive income. That means paying tax, and it means that value it's going to save you a whole lot of tax. So yeah, hopefully you found that useful. I'll share in a link for about Chattel's depreciation, and I'll share in that Valueit's website details as well. So hopefully you found that useful and got a lot from it. Thanks a lot. Bye.